Welcome to The Explainer. Today, we're diving into what is arguably the ultimate, lazy, totally stress-free strategy for building wealth. And the best part? It actively protects you from your absolute worst enemy in investing, your own emotions. Seriously, if you've ever felt that sheer panic during a market dip, or laid awake at night agonizing over the perfect time to put your money in, you are definitely not alone. We're going to unpack a system today that completely deletes that anxiety and replaces it with ironclad emotional discipline.
So let's set the stage by looking at two wildly different types of investors. On one hand, you've got the frantic 2 a.m. chart watcher. You know the type. Desperately refreshing their screen like it's a broken slot machine, trying to guess the absolute perfect second to buy or sell. On the other hand, you have the calm, methodical investor. This person simply ignores all the financial noise, sips their morning coffee, and entirely avoids the stress of predicting the future. How do they pull that off? Well, they just refuse to play the guessing game altogether.
Let's kick things off with the market timing trap and why buying the dip is actually a psychological nightmare for the human brain. Okay, get this. A really fascinating Charles Schwab study actually found that even the unluckiest investor on the planet, someone who miraculously manages to buy at the absolute peak every single year, still beats the person who just sits in cash waiting for that perfect moment. And looking at the data from JP Morgan, it brilliantly illustrates why. If you panicked and missed just the 10 best days of the S&P 500 between 2002 and 2021, your returns were slashed nearly in half. Half! The cruel irony of the stock market is that the absolute best days almost always happen right after the worst, most terrifying days. So panic selling during a crash doesn't protect you at all. It literally destroys your wealth because you miss the recovery entirely.
So, what's the fix? Let's talk about dollar cost averaging, the automatic wealth building system.
Dollar cost averaging, or DCA for short, simply means taking a fixed amount of money and investing it at regular intervals. You do this completely ignoring whatever noise the market is making. Let's say you commit to investing $300 every single month. Well, look at what happens in month 3 when the price suddenly plunges to $80. Because of your rigid rule to invest exactly $300, your money naturally scoops up way more shares. It effectively forces you to buy the dip, but without any of the emotional hesitation or fear that usually paralyzes us when the market drops. And by just stubbornly sticking to the plan, your average cost smooths out over time. It takes what is normally a highly stressful, adrenaline-fueled guessing game and transforms it into a low-stress, highly profitable habit. You don't have to be a genius, and you absolutely do not need to read complex charts. You just need the emotional discipline to stay consistent.
Let's move on to the Crash Survival Guide. This is the ultimate test of your emotional fortitude.
To really understand this, we have to look at a genuinely terrifying real-world scenario. The 2008 Great Recession. The market plummeted a stomach-churning 57%. Now look at the stark contrast in how two different investors reacted. The panic seller just couldn't handle the emotional pressure. They sold everything at the exact bottom, locked in a massive 50+% loss, and totally missed the historic bull run that came right after. But the DCA investor? They had the discipline to just keep buying. They blindly put in their $500 a month, no matter how bad the news got, and by 2013, they were significantly in profit. By 2018, they had literally tripled their total contributions. They bought deeply discounted shares all the way down and all the way back up.
So let's dig into the psychology of wealth and why your own brain is actually your biggest liability here. The truth is, we are biologically wired to flee from danger. Now, Vanguard found that putting all your money in at once, what's called lump sum investing, does win mathematically about 68% of the time. But here's the catch. The human brain simply cannot handle the emotional terror of watching a massive lump sum drop 20% in a single week. The cost of that panic is staggering, 3%. That is the annual behavior penalty identified in a massive 30-year study by Dalbar. That's the exact amount of wealth average investors lose every single year, completely unnecessarily, just because they panic sell at the bottom or excitedly chase trends at the top. It's not bad stock picking that ruins portfolios, guys. It's bad emotional behavior.
When we weigh these two approaches side by side, the true value of dollar cost averaging becomes crystal clear. Sure, a lump sum might have a slight mathematical edge in a perfect vacuum, but in the real world, DCA acts as a psychological shield. It fundamentally changes your mindset. Because you are buying constantly, you actually start to look forward to market crashes. Why? Because your monthly contribution is suddenly buying everything on sale. It completely reframes a crisis into an automatic discount shopping spree. All right, let's talk about how to automate your wealth and how you can start removing your emotions from the equation today.
Here are your 4 practical steps to get started right now. Step 1. Choose a broad market index ETF. You want a slice of the entire economy here, not just risky individual stocks. Step 2. Pick your fixed amount. And remember, consistency beats size every time, so even $50 a month is totally perfect. Step 3, and this is where the magic happens. Set up an automatic debit order right after payday. The absolutely vital step here is automation. By ensuring the money leaves your account before you even feel like you have it, your emotional brain never gets the chance to second-guess the investment. And finally, step 4. Do not touch it for at least 5 to 10 years. Just step back and let compound interest do the heavy lifting for you.
Now, as your guide through this, I really want to aggressively warn you against a few deadly pitfalls. You absolutely must maintain your discipline. Do not constantly change your investments based on whatever is trending on social media. And don't forget to bump up your contributions as your salary increases. But above all else, and I really mean this, avoid the absolute worst mistake you can make: stopping your automated investments when the market is crashing. That is the exact moment stocks are on sale. Stopping your investments right then is literally like running terrified out of a store the exact moment they announce a 50% off clearance event. It makes no sense.
The stock market is a device for transferring money from the impatient to the patient. This brilliant quote from Warren Buffett perfectly encapsulates the true power of everything we've covered in this explainer. Ultimately, wealth isn't about being the smartest person in the room. Dollar cost averaging is simply the automated system that forcefully ties your hands, removes your fear, and demands that you be the patient investor on the receiving end of that wealth transfer. To wrap up, I want to leave you with a bit of an accountability challenge to kickstart your emotional discipline today. Take a hard look at your finances, make a decision, and commit to it. How much are you planning to DCA every single month? Remember, the market does not care about your emotions in the slightest, but your future self, they will absolutely thank you for your discipline today. Thanks so much for joining me on this explainer, and I'll catch you next time.